Hello everyone and welcome to Financial Accounting. In this video we're going to be going over chapter 7, which is about internal controls and cash. This chapter is a little bit conceptual, so please bear with me. And when we talk about cash, of course this is an easy topic, we all can relate to cash. We are going to talk about something important, which is the bank reconciliation, which is the only technical part when it comes to this chapter. So the first thing that we're going to start talking about in this chapter is Sarbanes-Oxley Act of 2002. So this is an important act that affected the accounting profession and also auditors, which are the people who review and verify the financial statements. So the purpose of Sarbanes-Oxley was to maintain public confidence and trust in the financial reporting of companies. In the late 90s, early 2000s, there were a lot of financial scandals and people lost trust in the financial statements of these big companies. So Sarbanes-Oxley Act was to bring confidence back again and trust in these financial statements and the financial records. So Sarbanes-Oxley applies only to companies whose stock is traded on public exchanges, referred to as publicly held companies. So it doesn't apply to small companies or private companies, it only applies to companies that are traded in the stock market. Sarbanes-Oxley emphasizes the importance of effective internal control, and this is why we're going to spend a little bit of time talking about internal controls and how to maintain an effective internal control system. So internal control is defined as the procedure and process used by a company to do three things: protect assets or safeguard assets, process information accurately, and in other words we can say maintain reliable information, and also ensure compliance with laws and regulations and other policies that the company is following. So you see in this exhibit here the effect of Sarbanes-Oxley. Before the passage of Sarbanes-Oxley, like most businesses, they had weak internal controls which encouraged fraud and theft, and of course this had an impact on investors, stockholders and creditors. All of these group of people, or what we call them stakeholders, were frustrated with this kind of lack of internal control and theft. So when Sarbanes-Oxley was enacted in 2002, things improved significantly. So now there are more requirements for effective internal controls by all publicly traded companies. Of course, fraud and theft decreased significantly. It's not eliminated, but it's decreased significantly. And of course, investors, stockholders, and creditors, or these stakeholders, they have more trust now in the financial records and companies and the effectiveness of the business's internal controls. So one of the requirements that Sarbanes-Oxley enforced on businesses is that they have to submit, or senior executives or management, they have to submit some form of an annual report where they assess their own internal controls over financial reporting. And here we have an example for a company we all know, which is eBay, and we see the report of compliance with Sarbanes-Oxley. So here I'm going to read it just to make you familiar with the language. So as you can see, the title says Management Annual Report on Internal Controls over Financial Reporting, and it goes as follows. Our management is responsible for establishing and maintaining adequate internal controls over financial reporting. So this is an explicit statement that management is the one responsible for establishing and creating and maintaining effective internal control over financial reporting. Our management, including our principal executives officer and principal financial officer, conducted an evaluation of the effectiveness of our internal control over financial reporting based on the framework of internal control, integrated framework of 2013, issued by an organization called COSO, or the short name for it is COSO, but the full name is the Committee Sponsoring Organization of the Tradeway Commission. Based on its evaluation under the framework of internal control integrated framework, our management concluded that our internal control over financial reporting was effective as of this specific date. So again, I really don't want you to memorize this, but just be familiar that this is a kind of admission by management that they are the ones who established and maintained the effective internal control over financial reporting, and they're also responsible for evaluating the effectiveness based on a criteria which is called the Internal Control Integrated Framework. That's like designed by COSO. So what is Internal Control Integrated Framework? It's the standard by which companies design, analyze, and evaluate internal controls. We call it the criteria or the framework by which companies would follow, or yeah, it's the framework that companies would follow in order to be able to design, analyze, and evaluate their internal controls. By design, they put it together. They also create it and develop it, analyze it, and evaluate it on a regular basis. Internal control can safeguard assets by preventing theft, fraud, misuse, and also misplacement. A serious concern of internal control is preventing employees fraud, and this is very common in many businesses. And don't be surprised to know that employee fraud is much more dangerous than other forms of fraud, which is the fraud that's happening within the business itself. So employee fraud is the intentional act of deceiving an employer for personal gain. And this is, by the way, pretty common, and businesses, they put a lot of resources directed towards internal control that will prevent employee fraud. So what are the objectives of internal control again? Again, safeguarding assets or protecting assets, accurate information, and we can include the most important information would be financial information, and of course compliance with laws and regulations. So the objective of internal control are to provide reasonable assurance that assets are safeguarded and used for business purposes, business information is accurate, including financial information, and employees and managers comply with laws and regulations and policies set forth for the business. So now let's talk about the elements of internal control, and these elements are based on the internal control framework. And they are mainly 5 control elements, or internal control elements. They start with the control environment, risk assessment, control procedures, and monitoring. And then you can see here we have the 5th one, which is information communication. And in the book here, they present this in the form of an umbrella. And the 4 elements that we started with are, they are presented, these are the parts of the umbrella. But the information and communication is like the handle or the hand of the umbrella, where that holds everything together. And of course, the elements of internal control would protect management and businesses. So that's the main idea of having internal control, so you can protect the management and the business from any kind of external control threats. So let's start with the control environment. Control environment is the overall attitude of management and employees about the importance of controls. So how strongly the business believes in the value of controls. There are 3 factors that influence the company's control environment, including management philosophy and operating style, the company's organizational structure and how it's structured, and then the company's personnel policies. These 3 factors, they work together in creating a control environment. Management philosophy and operating style, like if management believe in the importance of controls, then this would be reflected on everyone in the business. So in other words, setting the tone at the top, as they say. If the CEO of the company or the chief executive officer of the company firmly believes in the value of controls, that would be reflected in everyone else in the business. Also the organizational structure, like how there are channels of authority and responsibilities within the business. And then personnel policies, like hiring the right person in the right place. That's also part of the control environment. So management philosophy and operating style relate to whether management emphasizes the importance of internal controls. The business organization structure is the framework for planning and controlling operations. And again, the business personnel policies involve the hiring, promotion, discipline, everything that's related to how human resources are managed within a business. The second element is risk assessment, and as it says here, all businesses face risks such as changes in customer requirements, competitive threats, regulatory changes, and changes in economic factors. So management should identify such risks, analyze their significance, assess their likelihood of occurring, and take any necessary actions to minimize them. So for example, COVID is one of those external threats that affect a business. It could be in a good way or a bad way. Also, some economic factors like inflation or increase in interest rate. These are economic factors that can create some kind of risk for a business, and management should identify these kind of risks and assess their chances and how significant it could be and their impact on the business, and how they can mitigate the impact of these kind of risks. So as you can see here, we have the control threats, and we can apply control procedures to protect the management and business. So what are the control procedures? These provide reasonable assurance that business goals would be achieved, including the prevention of fraud. So fraud is one of the biggest things for businesses, and they want to protect the business from fraud. So control procedures, which constitute one of the most important elements of internal control, include things like competent personnel, rotating duties, and mandatory vacations. So in many businesses, they want to make sure, again, they hire the right person in the right place. You want to rotate people. You don't want people to get too comfortable in one spot, because that can encourage them to start manipulating things and start taking advantage of their position. Also, mandatory vacation, and that's like in the banking industry, this is very common. You have to take a vacation for 2 weeks, so someone else would do your work. Also, separating responsibilities for related operations, and they always say you have to separate like authorization, often like taking a decision for something, so the authorization from record keeping from custody. So those who take a decision to buy an asset should be different from the person who would record the transaction, should be separate from the person who's going to handle or use the asset. So separating operations, custody of assets, and accounting, that's another example for that, and also proof of security measures. So competent personnel, rotating duties, and mandatory vacations. Let's talk more about these in detail. So a successful company needs competent employees who are able to perform the duties that they are assigned for. Procedures should be established for properly training and supervising employees. It's also advisable to rotate duties of accounting personnel and mandate vacations for employees. Cases of employees' fraud are often discovered when a long-term employee who never took vacation missed work because of an illness or another unavoidable reason. So sometimes these are the kind of things where we discover fraud that's happening. When we talk about separating responsibilities for related operations, the responsibility for related operations should be divided among 2 or more people. This decreases the possibility of error and fraud, because it's not the same person who's doing everything. If someone is doing everything, they can make mistakes, and also they can take advantage of their position. So if the person orders supplies, verifies the receipts of the supplies, and pays the supplier, the following abuses may occur. For example, orders may be placed on the basis of a friendship with a supplier, so I would only order from a supplier that I have friendship with, rather than selecting the best price or the best quality or other objective factors. The quantity and the quality of supplies received may not be verified. Therefore, the company may pay for supplies not received or that are of poor quality. So, because there's no one who's verifying what we're receiving compared to what we ordered. Supplies may be stolen by the employees. And of course, the validity and accuracy of invoices may not be verified. Therefore, the company may pay false or inaccurate invoices. So separating operations, custody of assets, and accounting, this is crucial. You don't want one person to be doing the 3 of them. The responsibility, in this way, the accounting record serves as an independent check on the operating managers and the employees who have custody of the assets. So now we have like separation of these 3 areas. When we talk about proofs and security measures are used to safeguard assets and ensure reliable accounting data. Proofs involve procedures such as authorization, approval, and reconciliation. And then we also talked about monitoring, which is one of the elements of internal control. And monitoring in the internal control system is used to locate any kind of weakness in the internal control that needs to be improved. And this is normal, because we cannot have an internal control system that is effective all the time. Technology changes. People are creative also in finding loopholes in the system, and they can find the areas of weaknesses. So that's why you need to keep monitoring this system to make sure that how we can improve the internal control system. So monitoring often includes observing employees' behavior and the accounting system for indicators of control systems. So warning signs of internal controls. So let's see some of the warning signs with regards to people. So something like abrupt change in lifestyle, without of course winning the lottery. So somebody who's suddenly driving a luxury car or living in a bigger house or spending like crazy, that's usually a red flag. Also close social relationships with suppliers. Again, when you get to be too friendly with a supplier, again, this tells like there are maybe some kickbacks or something that's going on. Refusing to take vacation. Some people say, oh, we love our job. And of course, yeah, many people like their job, but we still need vacation. So if they're not taking vacation, then that's a red flag. Frequent borrowing from other employees, which means that they're under financial pressure and they're living beyond their means, and sometimes this is a warning sign that people might do fraudulent behavior, and excessive use of alcohol or drugs, of course. And then there is also warning signs from the accounting system itself. So missing documents or gaps in transaction numbers. This could mean documents are being used for fraudulent transaction, or an unusual insurance in customer refunds. Unusual increase in customer refunds. So, like this is very common in some businesses, like let's say the fast food business, where you see like at the end of the day they're refunding a lot of their sales. Again, that usually is phony, and this is not really, like often. Like in fast food, we don't see a lot of returns happening, but sometimes they do that as a way of, again, taking advantage of the system. Differences between daily cash receipts and bank deposits. So that's another warning sign or red flag. This could mean receipts are being pocketed before being deposited. Sudden increase in slow payments. So employees may be pocketing the payments. In other words, we're collecting our accounts receivable, but they're not getting deposited right away. They're taking longer. Backlog and recording transactions, possibly an attempt to delay detection of fraud. So again, here we have like some kind of signs or warning signs for fraud, and I think this is good to know. So another thing is information and communication, which is the last element of internal controls. It's an essential element, and information about the control environment, risk assessment, control procedures, and monitoring is used by management for guiding operations and ensuring compliance with reporting legal and regulatory environments. Regulatory requirements. Management also uses external information to assess events and conditions that impact decision making and external reporting. So information and communication is the element or the factor that connects all the other factors together. So what are the limitations of internal controls? So some people think once we have an effective internal control system, that's going to be like a bulletproof, but that's not real. Internal control systems can provide only reasonable assurance, but they cannot provide absolute or 100% guarantee to safeguard assets, processing accurate information, and to be compliant with laws and regulations. That's not possible. You only provide reasonable assurance. In other words, internal controls are not a guarantee. So this is because some of the factors that we're going to be talking about. One of these factors is the human element of controls. Controls are mainly performed by individuals, and people make mistakes sometimes. So human errors can be part of the limitation of internal controls. Also the cost-benefit consideration. Sometimes it might be very expensive to have controls for something that's not really worth it. So it doesn't make sense, for example, to store something with low value in safe boxes. So again, why? Because of the cost-benefit consideration. But that doesn't mean that these kind of low-value items can still get stolen. So that's why the cost-benefit is one of those limitations in internal controls. The human element recognizes that controllers are applied and used by humans. Cost-benefit considerations recognize that the cost of internal controls should not exceed their benefits. And that's one thing to remember. So let me stop here. In the next video, we're continuing our discussion, and we're going to go over cash controls over receipts and payments.